Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this October 31st, 2023, for a briefing on how we're seeing the conditions in the markets and what the prescription or playbook from our lens going forward for the back quarter of 2023 and early 2024. So again, thank you for being here and allow me to share the screen so we could get this going. So here we go, and there it is. Okay, so here are our disclosures, as you see, and let's get to it. The title of this talk, Balancing with Caution, making sure we protect our clients' assets proactively and empathetically, but to also grow those assets in this new regime, this new economic circumstance that we're seeing going forward. That's how we see it. So here's the how we're going to do that. Number one, and most importantly, respect cash and T-bills. Active management is back, as you'll see in a moment. That's another piece of this. We're balancing our exposures, cash and T-bills on one side, by the way, 5% return, thereabout. And on the other side with the balancing bar, we will take risk in selective sectors. We want to overweight real assets and inflation-centric assets. We want to overweight asset-light operating models. We want to understand this new regime, this new set of conditions that we think has a long lead time. And we want to underweight, stay away from the long duration assets like large cap growth and long-term bonds. Okay, so as we've said for a year and a half now, maybe two, we called this inflation back in mid-21. So it's been a while, 2 years, a regime change. After 40 years where markets have been buoyed by ever-present lower interest rates, we see now that we're on the other side of that inflation is now going to be it's going to be stickier and it's going to be around longer. And there's a couple of reasons for that. We no longer have the globalization that we'd had. And of course, we have labor on the ascendancy as we're seeing more and more strikes. And of course, there's also the net zero movement. We'll get into that in a second. So here it is, basically, the new regime. The wind is no longer at our backs. Again, folks, this is big picture, right? This is the conditions that we see right now and we see going forward. No longer can investment management be orchestrated passively. We believe active is important. And again, deglobalization, near-sourcing, near-shoring, labor strength, 500,000 strikers year-to-date 2023, a 40-year high. From this, what we take from this is a more value-oriented, fundamental analysis-focused portfolio, more resource-based companies with pricing power, commodity exposure for the first time in 20-some-odd years. We're cautious again on high multiple stocks and bonds. This is a picture that says 1,000 words. Thank you to Stephanie Pomboy. Straight down in interest rates until 2020, post-COVID, when the Fed left a massive stimulus on for too long. They cooked it. And this is the greatest bull market ever, the greatest, run in bonds from 20-some-odd% in 82 to zero. Essentially, when the price of money goes that far down from year after year after year, anything that's thrown at the economy, any kind of disruption, just lower interest rates because they had disinflation at their backs. We no longer have that. So we no longer have this wind. So enter the new regime. First off, we got to talk about debt levels. I mean, there's no way out of this but by inflating it away. Something's got to give here. Look at this one. This is the inflows and outflows. I love this chart. Look at the net interest, right? 659 billion. That's going to balloon, as you'll see in the next chart, because obviously we have a higher interest rate now on the massive amount of deficits that we have to fund. But this gives you a good depiction of the deficit Here's the inflow, here's the outflow. Oh, and by the way, there's no one cutting this stuff. We're not cutting national defense. No way, not now. Or veterans benefits or Social Security. If anything, net interest is going to go up, as I just mentioned. So we got an unbalanced situation. And of course, there's deficits upon deficits, as we can see. This is 31% of all U.S. government debt outstanding, 7.6 trillion maturing in the next year. What do you think they're going to be paying on that debt? A lot more than they did. So this is part and parcel to this chart, which shows how debt service is going to exceed the national defense budget. I mean, can you imagine that? So we have an issue on the monetary side, on our fiscal side, and that is it is very serious. And we've talked about this for a few years now. This debt issue has to be respected, and therefore is why we are in a balanced approach, because it is not the kind of conditions where we can just go all in. Some market internals for you to look at. This is valuations. We look at the Shiller index, the Shiller PE. Again, remember, it's a smoother. It looks over 10 years. And here you're looking at the consequence of the current Shiller at 29x, 29 times, indicates a 4% annualized total return for equities over the next decade versus 12% from 13 to 23. Big difference. So this is why we're very much on the lookout for opportunities outside the S&P. As you're going to be small caps, you're going to be in international markets. Here's profit margins. Obviously, these have been also much higher and much elevated because, of course, interest rates were low for so many years. But no longer is that there. No longer is the wind at the back of profit margins. That's going to be a consideration for earnings. And here's the equity risk premium. What this takes a look at is the reverse, the inverse of the PE. It's essentially the yield on the price of the stock from its earnings compared to the Treasury index, the Treasury bond. As you can see on the bottom, it's right there. And when they minus out the Treasury, the risk-free rate, you get something called a risk premium, the equity risk premium. How much return are you getting from those equities, the S&P 500 in this case, when you take out versus the risk-free? And in this case, you could see not much there. So you want to be buying equities when there's a high equity risk premium. You're getting a big return for your risk versus the risk-free rate. But because bond yields have been up, the equity risk premium has come in. That's concerning. That tells you the valuations and the relative attractiveness of equities is not where it needs to be to get super bullish. Doesn't mean there isn't other places we could find opportunity, just not the S&P 500. And this brings in active management. So it's no longer throwing a dart against an index and just making money that way. That was this period. Actually, it was this period. And now we're in a new zone where now it's going to new regime where now active management is going to outperform. And that's where we are today. And that's why we're so excited about some of the opportunities that we're finding. Where are those opportunities? That's good. Okay, commodities. Look how undervalued commodities are versus the markets, versus the overvalued previously back here in even in the 30s. So this is an opportunity in here, a deep discounted opportunity versus the Dow Jones. And this shows you a super cycle of commodities. Very important to look at that and to understand that as an opportunity going forward. We think commodities are cheap and opportunistic, especially when you look at climate focus and how you're seeing the ESG movement. This is a real interesting slide about copper. Check it out. Goldman says almost double the amount installed last year. China will install 150 gigawatts of copper-intensive solar energy capacity this year. Double. Which China's already has 30% of the world's hydropower storage capacity and are looking to build even more. Copper is going to be a critical resource. We don't have enough of it, and that's part and parcel to the inflationary call. This is the net zero movement, which is in part moving that copper down the road, and part of the reason why we're bullish on copper. Now, oil is also something we're looking at, and we find it as opportunistic at these levels. Look at the SPR. This is the stockpiles of oil down pretty low, and the Strategic Petroleum Reserve has also been depleted. We like gold, especially in a scary world, and God, we know it's scary out there. So we definitely want to have some gold exposure, not just for the inflationary circumstances, but also the ballast that it provides in geopolitical risk periods. Current playbook: overweight cash, respect volatility. Fixed income is not the ballast it once was, folks. So be cautious, stay short, high quality. Dividend growth, value style, inflation-centric sectors, real assets, infrastructure, companies with pricing power. Of course, you know, the water sector, which has been a favorite of ours for years now. But stay invested. That's another big message here. Work the edges. Have your portfolio work the edges, be proactive, be active, but don't do this game where, oh my God, the market's coming down, I gotta get everything out. That's not gonna work. How are you gonna know when to get back in? Better to have a defined portfolio, have cash that supports it on the sidelines, and get ready to put money to work when things go down. So that's an important consideration too. We love Japan, very cheap, very opportunistic, lots of companies with net cash and opportunities going forward. Value, as I mentioned, extremely cheap. And as you can see here, when value gets cheap, it gets opportunistic, as you can see in these different models here. Real exciting times for us here at ALINE Wealth. Thank you for your attention. Thank you for your commitment and your vote of confidence. We're here to serve. Have a great day.